So in the previous lesson, we have talked about two important players in the stock market, that is the investor and the trader, both of them having a different agenda. The investor wants the price to move only in one direction, that is the upward direction, whereas the trader wants the price to keep moving up and down. Alright, now we shall have a look at the third important player, who is called an arbitrator. Now, who is an arbitrator? What does he want from the stock market? What does he do? What is his intent or agenda? We will see all this. But before that, if you have a look at the meaning of the word arbitrator in a dictionary, then the arbitrator is a person who resolves disputes out of court. If there is a dispute between two people, then an arbitrator mediates and resolves that dispute out of the court, and he does it very quickly, satisfying both the parties. But what does he do in a stock market? A stock market arbitrator does something similar and for his own benefit. But what could be the dispute or the differences in the stock market? There are no enmities, there are no war, there is no fight. But yes, at times there are differences. And what could be those differences? One difference could be that the price of the same share, any share you consider X, Y, Z, the same share may be trading on two different exchanges at the same moment, but at a different price. Alright? Or there could be an abnormal difference between the price of a share on the exchange and the derivative of the same share on the same exchange. For example, let us say that a stock X, any stock, say consider Tesla or Tata Motors, anything you may consider, it is trading on Nasdaq at $50 per share. Alright? And the same share is trading on Dow Jones at the same moment at $55 per share. At the same instant, the same time. Normally it does not happen, but at times it does happen. And an arbitrator is on the lookout for such opportunities. Alright? Or you can say that a stock is trading on the Nasdaq at $50 per share, and the derivative or the futures of the same stock on the same stock exchange is trading at $57 per share. Now, if the difference is small, then it doesn't matter. For example, here, if it is from 50 and on the other exchange it is 50.5 or 50.4 or 50.6, it won't matter much. But when the difference is more, then somebody would like to take an advantage of that, and that is the job of the arbitrator. Similarly here, a futures or a derivative of a stock normally would be costing slightly higher because of various reasons, like the cost of carrying and interest and other things, but not this much of dispute. If the stock is trading at $50 per share and the derivative or the future is trading at 51 or 51.5, it is understandable. But this difference is quite wide. Alright? So therefore, there is a dispute or a difference. Now, what does an arbitrator do? An arbitrator would simultaneously buy one and sell the other, thus making a risk-free profit, though that profit is very small. Alright? For example, what he would do is, he may buy 1,000 shares of X on Nasdaq at $50, and that very moment he may sell them on the Dow at $55 per share. So on every share he is making a neat money of $5 minus the taxes and the other expenses, at least 4 or 3.5 he would make it. Alright, so this process is called as arbitration, and the job of the arbitrator is to look for such opportunities and take advantage of such opportunities. Another case, consider that he may buy the shares of the same company X on Nasdaq at per share, and he may sell the futures of the same shares on Nasdaq itself at that very moment at $55 per share. So again, he makes a neat risk-free earning because he is doing both the things simultaneously at the same time. Such opportunities, fleeting opportunities, do not come often, but yes, at times they do come, and an arbitrator is an expert in spotting such opportunities. How does he do it? Why does he do it? That is beyond the purview of this course. We have seen that in one of the other courses. But here just try and understand that there is a player called as arbitrator and he is doing something. Alright? He is neither interested in the price going up nor he is interested in the price going down. He is neither interested in the business, neither interested in the company. All that he is interested in is that at a particular moment, at a given spot of time, there should be substantial difference between the two stock exchanges, the price of the same stock on two different stock exchanges, or if it is on the same stock exchange, then there has to be a substantial difference between the price of the stock and the price of its derivative, that is the futures. And if he finds such an opportunity, he takes advantage of it. So an arbitrator does not wait. He simultaneously takes a buy and sell action. Unlike an investor and a trader who take some time, even a scalper takes a few seconds to make a decision or decide whether he has to buy or sell. But an arbitrator does both the things simultaneously at the same. How does it do it? We are not bothered, as I've told you now. That is not within the purview of this lesson. But yes, it is a specialized work and he is a specialized person and he does it efficiently to make a living. So in the next lesson, we will see another important player who is called as a hedger or a hedge fund, as you may have sometimes heard about him. Alright.